Are you ready to make the most of your oil and gas mineral rights? Welcome to the Mineral Rights Podcast. Get the knowledge and resources you need to manage your minerals and royalties. Here is your host, Matt Sands.
Hello and welcome to the Mineral Rights Podcast. I'm your host, Matt Sands, and I'm joined by my co-host, Justin Williams, and we're here to help you make the most of your minerals and royalties. In this episode, we're going to talk about the latest oil and gas and mineral rights news for August of 2025. And, it's a lot of the same things that kind of keep coming up in the headlines, Justin, as we were talking before we hit record around oil prices and geopolitics.
Yeah, you said it, Matt. There's just so much going on that, it's kind of the same story of different things that may impact it, but, time will tell what exactly is going to happen. And that's exactly kind of what our stories are about here is different commodities and kind of the different price fluctuations, which just is the nature of the beast right now.
Yeah, it's the nature of the industry. And this is nothing new as far as oil and gas is concerned. And, you have these boom and bust cycles that tend to repeat themselves. And this first article actually talks about that and that volatility and what it's doing to the oil markets. So the headline is Deal Making in U.S. Upstream Oil and Gas Tumbles as Volatility Rattles Investors. And the key highlights here are the fact that volatility in markets slowed M&A in U.S. upstream oil and gas. There's only been a couple of major deals this past year, so far this year, that they highlighted in this article in particular was EOG Resources purchased Encino, which is one of the major operators in Ohio in the Utica. And so that was a big acquisition. That was $5.6 billion in May was when that was announced. And then the other one, which actually is directly related to minerals and royalties, was the acquisition of Sitio royalties by Viper Energy. And both of those are publicly traded mineral and royalty companies. And Viper, interestingly enough, is the mineral and royalties arm of Diamondback Energy. So for a long time, Viper's business model was to purchase minerals in the area where Diamondback was the operator. So they effectively had control over the drill schedule. They knew, okay, we're going to go to this area next, so we'll go in and buy minerals there. And so there was a really good returns on investment because of that line of sight to near-term development and when they would start receiving royalties. So that was, pretty interesting to see them sort of branch out and purchase Sitio, which is one of the larger publicly traded mineral and royalty companies. But, pretty interesting, not surprising, I guess, that you have a lot of volatility in oil and gas. People are not really sure where the market is going next. And so they're going to pull back a little bit and see what happens. Because, when you underwrite these large mergers, you have to have some assumption as far as what oil and gas prices are going to be in the future so you can figure out what the company is worth that you're purchasing. And so when prices are swinging up and down really, rapidly, it's hard to come up with an estimate that's accurate as to what the oil prices are going to be in the next year, 2 or 3 or whatever. And so that's not a big surprise that you see this headline.
Yeah, you said it, Matt. Both sides want to wait until the market has some stability to get through the process. And though many of these deals may continue, it just may be a pause for now till it changes. So, Matt, the next one here is about precious metals and the prices surging amid the geopolitical and economic uncertainty. The headlines here, Matt: platinum saw a 28% price surge in June, marking its strongest monthly gain in decades, driven by supply concerns and investor interest. Palladium jumped 19% amid the shift in sentiment and output cuts, though its long-term demand faces pressure from the EV transition. And then silver climbed nearly 8%, nearing a 13-year high, while gold remained stable at around 3,300 amid Fed uncertainty and geopolitical tension. And so, Matt, this has kind of been a story that we've talked about over the last, 3 years. Just some of these other items like palladium, lithium, which we've talked a lot about, different things are really going up in price due to all the technology that we're using today.
Yeah, it's interesting to see this. And the precious metal side is particularly interesting because a lot of times people will invest in precious metals as a hedge against inflation. And so, gold is kind of the I guess, the standard, right? It's in terms of people, investing in something that's seen as a relatively stable asset that, really has been kind of undervalued for a number of years. And then just really in the past couple of years, it's rallied significantly with gold prices now, around $3,300 or $3,400 is kind of range, in that kind of range. It's been going up and down. So, if you've been a gold investor for a while, you're pretty happy about that. And, interesting that, from an economic standpoint, I think this article, talks specifically about these different precious metals. But, if you kind of look back at the 30,000-foot view, there is thought that there's increased chances of a rate cut by September, things like that. And so people are looking at, where can I invest to get a good return, a safe return, and sort of have money that is not going to be eroded by inflation and things like that. And then with interest rates going down, if you had money in, let's say, a CD or a money market fund or whatever, it's going to have a lower return. So you want to look at something that's you think is going to do better. So, maybe that's some of what's driving this, but also I think there's always this economic uncertainty that's going on right now with all the tariffs, and that's all tied to geopolitics as well. So there's, all the things going on in the Middle East with Israel and Iran and Ukraine and Russia and all of those things that play into, people's sentiment, right? And how they're feeling about what's going on in the world. And if there's, hey, things are pretty uncertain and there's all these conflicts, I'm going to get out of the stock market because I think it might fall or crash, and I'm going to throw money in gold and stuff like that. So maybe that's what's happening too, because, on the same lines, Bitcoin has gone up and it's been reaching new highs near $120,000 per Bitcoin. And so, kind of have seen that as sort of what's almost seen as a safe haven asset nowadays, as compared to being more of a risk and kind of a tech type of a correlation. So, yeah, interesting to see this.
You said it, Matt. And, I really wonder how much Bitcoin's playing into it, because the government's also been talking a lot about, Bitcoin as if it's an accepted currency, and that they're going to get involved with it and, push towards that technology, which is a really interesting change of tone. So wonder how much of the hedging is going towards Bitcoin instead. And Matt, kind of to back up the sentiment of nobody really knows what is going on. Our next story here, we were talking before we hit record, just kind of about the history of how this developed. And it's certainly no surprise that we ended up here, but I know it's startling to me to see these be so far apart, because it makes it hard for us that don't stay really in tune to know where to fall on this. And as you were saying, Matt, it's probably somewhere in between, but let's dive in. So the headline here is 18 trillion or total nonsense. So OPEC projects oil demand will hit 123 million barrels per day by 2050, calling for 18.2 trillion in new oil and gas investments. While the EIA, however, believes demand will peak before 2030 and dismisses such long-term investment needs. China's demand may be plateauing due to EV adoption, and India's growth is rising, but it's uncertain in the geopolitical world where that production will come from. So, Matt, this is the story kind of goes on and covers some other highlights, but to have these two people so far apart, it's causing some concern and certainly worth the headline.
Yeah, it's an interesting headline. And, we started to talk about the divergence in the opinions around peak oil between OPEC, which is, the cartel that sets oil prices, internationally, besides what's going on here in North America for the most part. And then the IEA, the International Energy Agency, which frankly has become, I think, pretty much indoctrinated by the thought that we can electrify everything. So they've been very much downplaying the role of oil and gas and fossil fuels in the energy mix in the future, despite signals that, developing countries that are trying to, provide reliable and affordable access to energy to their people who have never had that before, they're going to go with the lowest cost option, which typically is going to be coal or, oil or gas, as opposed to going to, installing nuclear power or solar or wind. And so, I think that is some of what's playing into this. And so that's why you see the article focus on China and India in particular, because they're huge demand for energy, and they're, kind of going up that curve. And China's further along than India. I think, obviously they're a manufacturing powerhouse and they use a lot of energy for that, but then also have a lot of vehicles, and they're really pushing EVs and, affordable EVs, which is interesting. But yeah, there's this, and actually we'll link to in the show notes. I think it was in the end of 2023, we highlighted, I think the last go around, and this was actually around the COP28, that the energy transition, the climate conference that happens every year. And this one, the OPEC had really was outspoken in saying that that the IEA was wrong in their assessment that oil and gas was pretty much done for, and saying, no, you're wrong. And it's actually, we're going to be around for a long time. So, not too surprising, Justin, that we see these two opposing viewpoints, because on one hand, OPEC has a vested interest in promoting oil and gas. And then on the other hand, the IEA is kind of fully embedded into the whole net zero and energy transition mindset. And so those are very two, in that spectrum, those are two opposing viewpoints. And so where OPEC forecasts the oil consumption will climb to 123 million barrels per day by 2050, which is higher than the current projection for this year of 105 million barrels per day. And then, on the other hand, IEA is saying, okay, we're going to plateau in 2030, and by 2050, we'll be below, that number, and it's probably going to be below 105. So that's a pretty big, like you said, divergence in what we think is going to happen in the future.
Yeah, you said it, Matt, and it'll probably fall somewhere in between. And the article also mentions AI and kind of the energy demand that comes from that. And, that's kind of no matter where you're at in a different stage, Matt, for us to take the next leap with artificial intelligence and be the forefront there, we need the access to energy. And these companies are already making long-term contracts with either nuclear or gas-powered generators. So it'll be interesting to see how the landscape changes. I know China has certainly looked at and implemented a lot of nuclear into their energy, but it's not something that we see a lot of talk about in the United States yet. So I thought it was also interesting, Matt, in the article that the U.S. Energy Secretary, Chris Wright, they asked him about this, and he called it total nonsense. So the IEA is they, like you said, Matt, over the last few years have been really progressive on this, and not everybody agrees.
Yeah, and we'll link to a couple of episodes we did regarding the energy transition, how long it's going to take, and some of those focus on demand and what that future demand is going to be. Because we went through, there's a couple of things. The Shell has these energy scenarios they publish every few years, and then BP has the energy outlook. And so we did a deep dive onto those two, and those have some numbers as it relates to oil and gas demand. Into 2030 is kind of the number that's thrown out there, or the date that's thrown out there as a target for some reduction in emissions or some reduction in use of fossil fuels, and a measure of what we think renewables is going to look like then. And, so I think it's, like you said, Justin, I think it's that mix of these two very opposing viewpoints. The reality is probably somewhere in the middle. I do kind of tend to agree with Chris Wright's assessment of the IEA being that they're a fantasy, honestly, based on the current demand and the current demand growth projections, especially with all these countries that, like we've talked about in the past, that are trying to, give their people access to energy so that they can thrive and live longer lives. And so there's, right now about 2.3 billion people that lack access to clean cooking facilities. And that causes a lot of unnecessary deaths. And you can eliminate that by giving those people access to electricity to cook and to heat their homes and things like that. And that, and a lot of times is going to be a net benefit to them, even if it is coal that's burned to generate that electricity, because they're not going to be breathing in that particulate matter in their kitchen with the dung or the wood that they're using to cook with or to heat their homes with, improper ventilation. So yeah, there's a lot of that goes into it. You could have a full episode, and maybe we'll take another look at, the role of energy and what the future might hold. But we did a deep dive on that on episode 245. So we'll link to all of those episodes in the show notes. But yeah, it's a very interesting philosophical discussion as to what direction should we head, what's good, what's bad. But at the end of the day, I think, people want energy, they want access to that, and they're going to do what it takes to get it.
Yep. I think you said it, Matt. And, the rig count shows that. So that's what's next up here. And we added 7 land units. And I thought it was interesting to look at it. We have it broken out by oil and gas. So 422 oil units currently, 117 gas units. We added 9 gas units and lost 2 oil units. And Matt, looking at the different states and shells here, it looks like really the narrative of companies are looking at second tier acreage is holding true, because we've lost 2 in Texas. Looks like New Mexico is up, and some of the other states as well.
Yeah, kind of that theme. We keep seeing a little bit of a shift towards gas, like you said. We got 7 net rigs that we added, and all of those went to gas plays, and primarily in Louisiana and the Haynesville, and then some oil stuff going on in Utah. There was 1 rig added there. Interestingly, I think they're taking another look at the railroad to get oil out of the Uinta Basin to transport it east so that it can be refined, and taken to other refineries in kind of the mid-continent region and so forth. And so that is with the Trump administration, taking a harder look at that and challenging the previous administration's blocking of that railroad, because that's going to be a key factor in, the takeaway capacity for the Uinta Basin. And if they can increase the takeaway capacity, then I think more operators will go there and drill, and so they have a place to take that oil. And actually the basis differential will be lower. In other words, the price that they would get for the oil there in Utah would be higher than what they would otherwise get, because there'd be lower transportation cost if that infrastructure is there in place. So yeah, interesting to see Texas dropping, which is, kind of surprising, but I think you're seeing a shift into New Mexico. So I think those rigs are just going from the Texas side of the border into the New Mexico side of the border. It's still in the Permian for the most part, but yeah, it's interesting to see the shift, and it's good to see that we have actually maybe bottomed out a little bit, that we're ticking up a little bit, and we're still down from a year ago. It was 564 rigs operating, and again, we're at 529 as of the week of July 18th was when we pulled this report. So yeah, interesting, good, I guess maybe a little bit of light at the end of the tunnel as far as the rig count is concerned, and hopefully this kind of plateaus and kind of stays stable from here on out for a little while.
Yeah, it'll be interesting, Matt. And it'll be curious if the story is an ability to get this to market, because that could certainly be the case in the Permian Basin in Texas, with different pipelines, and like with Utah, like you said, if they can produce it, that's great, but they've got to be able to get it to market cost effective. And I know, like in Utah, it's a tricky situation, and with the focus on gas, that's going to be the primary infrastructure.
Yeah, for sure. And, I think that the thing we're seeing right now, the oil prices as it stands today, West Texas Intermediate was around $65 per barrel. Henry Hub gas was still above $3 per MCF, although it's come down quite a bit since the beginning of the year. We peaked, I think, up around $4. But, $3 an MCF is still relatively good from an economic perspective, although I'm sure those gas-focused operators are going to want to see that not go below 3. If it does go below 3, then I think we'll see a shift back to more oil focus, because this rig count is definitely a lagging indicator. So in other words, companies react several weeks or several months after what the market does. If prices go up, they're going to say, it's economic to drill these additional wells now. We'll start moving assets and people, but it takes time to order the materials, the contracts lined up to get the rig going and all of that. So that's why you see this sort of a lagging prices, even though they've come down in the most recent weeks. So,
all right. Well, I think that sums it up, Matt. And an interesting news cycle. It's not as busy as some of the news cycles have been, but kind of the same things being said, just in different ways. But as some of the geopolitical stage settles out, I think, we'll start heading in a certain direction more so.
Absolutely. All right. Well, that wraps up this episode. And again, we'll link to all the articles and the resources we mentioned in the show notes, which you can find at mineralrightspodcast.com. If you've come across an interesting article you'd like us to cover, you can send it to feedback@mineralrightspodcast.com, and we'll cover it on a future episode. Thanks again for listening. Thanks, Justin.
Thanks, Matt.
Thanks so much for listening to the Mineral Rights Podcast with your host, Matt Sands. Don't forget to subscribe and share at mineralrightspodcast.com. The Mineral Rights Podcast should not be construed as investment, legal, or tax advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy.